very happy to be here to talk about it truly is an ever evolving area sector of the law and what we deal with day in, day out. I know for me in the investment fund space, a lot of developments happening, and I think it's the same in the oil and gas sector as well, which Miles and Sinem will speak to. So Claire kindly introduced me and Miles, but maybe Miles or Sinem, maybe just introduce yourself to the crowd as well.
Sinem, why don't you go ahead?
Okay, sounds good. Hi, everyone. My name is Tina Marsoy. I'm an associate at the Corporate and Capital Markets Group at BLG's Calgary's office. I am also part of the firm's ESG initiative, so I help clients with ESG due diligence and ESG policy writing, and I'm looking forward to our chat today.
Great. Thank you so much, Sinem. So today we'll be covering two broad topics, and we'll obviously go into the details, but I will be speaking about as asset management and ESG investing and sort of all of the implications there, touching on the regulatory environment, and then some best practices and then different duties that firms in my space face, and then Miles and Sinem will go into a deep dive on ESG in the oil and gas industry. So starting here with the asset management piece, really this has been and become very much like a hot topic over the past 5 years, but in particular 3 years or so. And really the pressure the industry is seeing is from investors. Investors of all types, can be like an investor like me or a very large pension plan institution. And there's just a lot of pressure for firms, asset managers, money managers to integrate ESG considerations into the different strategies that they offer to clients. Clients want that. Clients want to know, climate change is obviously one of the big focuses. Clients want to know what strategies the firm is using to address climate change and climate change disclosure. Getting that down is key for a lot of investors. So this is the pressure is coming, and we are seeing then regulatory considerations in Canada, elsewhere around the world, about how a firm in this space can comply with some of the sometimes or a little bit hazy ESG factors, and really on that piece. So just some of the issues and challenges that firms face. The main one here, and this is sort of where the regulators I think are mostly focused, the securities regulators, is on greenwashing. So essentially the asset management firm will say, client, we offer you, publicly in their marketing, they'll say, we offer, strategies that focus on diversity of boards, or we do not invest in this and this, and then behind the scenes in practice the firm doesn't put that in place or doesn't fully put it in place as to what they've told the client. So it's greenwashing because they're just trying to attract clients and business and take the easier path, which is saying they do something but not fully doing it or following through on it. And that is one of the big focuses of the regulators, which I will talk about in a second. Another things like terminology, ESG, environmental social governance, it can mean different things to different people. So there's no sort of clear defined terms. I mean, the industry has terms, the regulators have used terms, but not always consistently. Disclosure is an issue, so lack of clear disclosure for investors. Hard to monitor performance sometimes, quantitative measures, and then that sort of ties into, there's a lot of data and different ESG ratings, providers out there, some of them better than others. So again, issues in terms of that kind of consistency. And then because it's such a new space, you don't necessarily have expertise at all of the asset managers that manage money, which can also, itself obviously cause some issues. So sort of really briefly, and stepping to kind of now we're talking about what kind of standards are in place that govern a firm that offers ESG strategies or wants to invest in that way. And so there are voluntary standards that essentially the industry or industry groups have promoted and put out there that firms then can say we adhere to this particular standard or framework or principles and give some confidence to investors about what factors and standards they use. So probably the most prominent principles of responsible investment, sort of a nonprofit group that has put together, I think it's 6 principles to follow for firms when they are investing in or have an ESG strategy. And that's a very, very common one we see our clients adhering to or agreeing to. Net zero framework, investment framework that's focused on climate change. Again, another sort of very framework that provides best practices when you're trying to invest in a way to minimize exposure to climate change or companies that are in that space. And then the CFA Institute has put out disclosure standards. The CFA is sort of a broady industry association that offers like the leading course for investment managers, investment professionals to take. It's the CFA. And so they have put out some disclosure standards for firms to follow, again, when they are speaking to clients about these, about their investment strategies or ESG strategies. So turning to the securities regulatory environment, there has not been yet from the securities regulators any actual rule or regulation. So there is nothing that says firms, you must do this or you must not do that. How the Canadian securities regulators have tackled this, so far at least, is by putting out guidance and putting out other information, reach outs, and then also conducting different kind of regulatory reviews of firms. And so the first one there is a regulatory review that Ontario Securities Commission and other regulators in Canada, the other securities provincial regulators have been undertaking since about 2020, 2021. And it's focusing on the disclosure piece. So it's focusing on firms in the disclosure that you provide to clients and to the market. You say you do this. Let's go behind the scenes, see what policies and procedures and governance structures you have in place to make sure you are doing that, and also make sure that you are implementing. So essentially greenwashing and making sure there's not a disconnect between what a firm says publicly and what it actually does and puts in place. So that's the review that's been happening of investment fund issuers, so like mutual funds. So you go to your bank, that kind of mutual fund, that retail mutual fund that you can invest in. That was the focus of that review. Similarly, there's been a review of actual securities registered firms. So this would be, your investment advisor, your investment dealer. And a very similar review by the regulators, again, to see what firms are saying publicly about the different strategies that they offer, and then making sure that, behind the scenes, the firm has policies and procedures in place to adhere to these standards and is actually following through. So those reviews have been ongoing, as I said, and they have resulted in what was guidance released by the securities administrators, so the entire group of the provincial regulators and territorial regulators in 2022. And the focus there is on telling the investment fund issuers, or giving them guidance, I should say, about best practices when having a fund that really has an investment strategy, an investment objective that is ESG focused. And so I'll get into some of the details in a second on that. But that was January 2022, and since then, there's been the regular review that we undergo with the Ontario Securities Commission when an investment fund wants to sell securities publicly, and so there's a review by the regulator of the prospectus offering document, and so it's become a very much a hot topic for those investment fund issuers during those reviews to clear any comments that the securities regulator has about the ESG strategies. So that is a very much a focus of the regulators when undertaking those reviews, and they refer to this guidance obviously in providing their comments, but it is often a sticking point. So then just recently, there was a webinar that the Ontario Securities Commission co-hosted with IFIC, which is the Investment Fund Industry Association, to try to clarify some of that guidance a bit. And then they have said more guidance will follow. And I'll talk about that session in a moment or two. So this is the staff notice that I mentioned that was from 2022. Really is clarifying how the different ESG disclosure applies, and it really is the current disclosure rule. So as I said, there are no new legal requirements here. It's essentially the regulators helping the industry to understand how the different current requirements apply if there is a particular ESG focus. And as I also mentioned, this only applies to that retail investment fund that any person in Canada can invest in, so the one that you would get from a bank, and that would have public disclosures. There are also investment funds that are only open to certain types of investors, institutional investors, so like pooled fund, your hedge funds. This notice and guidance does not apply to that type of sort of private fund, but still a lot of those kind of private issuers are referring to this guidance as well, and the regulators sort of are encouraging that. I think the notice, it's helpful in some of the context and the background it provides, and so it's almost for anyone that's sort of interested in ESG, a good kind of read and resource, because as you see on the slide here, the regulators provide their idea or what they think some of these ESG factors need, and these are not exclusive or exhaustive. They say there could be other considerations, and of course this is as we called our presentation, this is ever evolving, so always changing, and there could be more factors in the future. But I do think it's a bit of a handy summary, at least where the Canadian securities regulators are looking and they're thinking. The notice also provides, again, a kind of a nice little terminology section, and also a bit of a discussion about the different types or categories of ESG investment strategies. For instance, like negative screening, which is where the investment fund or the asset manager would say, we do not invest in tobacco companies, and therefore that would be a screening out of that kind of type of investment. So some of that context background I find helpful to sort of help provide some sort of consistency in this space in terms of the terms and some of the types of investment strategies. So turning broadly to the areas that are addressed in this staff notice, I mean, one of the big ones, again, this gets back to the greenwashing, is the making sure that there's a connection between the investment fund name and the objective. And so the essential idea is, if a fund calls itself Green Climate Investment Fund, then the objective has to reflect that it has a climate investment focus. So that's sort of the key, because I think what the regulators were seeing was a lot of current funds that were just changing their name and not necessarily changing their fundamental investment objective, and they say, well, that you can't do that. That's greenwashing. You're not, you're misleading in a way the investor, because all they see is a fund name, and they go ahead and invest and think it's an ESG focused fund. So similar points about different fund types. If it's an equity fund, for instance, clarifying it's it might be a particular type of equity security that the fund's investing in. Investment strategy disclosure, again, the focus really is on being plain, direct, straightforward, but providing a fulsome description of the ESG strategies. If like a proxy voting strategy or shareholder engagement is a focus, the fund should describe that. The risks, again, if there's a particular risk, for instance, that the issuer only invests in climate-focused companies, then potentially you might need to disclose a particular climate change related risk, or if the industry itself is uniquely impacted, say by climate change, again, that might be a risk to describe. Also, the investor can determine that it's a suitable investment. Last point there, sales communications, again, that gets back to that marketing point, to make sure that the marketing material is accurate and connects with the actual prospectus or the offering document and the objectives in that offering document. So on the webinar, just very briefly, it was clarifying the regulators' focus and what they consider in a fund that has some ESG, related strategies, but it's not the main focus. And essentially, they're just trying to say if it's material to what the fund is doing, disclose it. If not, consider not disclosing it. So again, we're just example evidence of how much this area is changing, day to day, month to month. So on the policies and procedures and practices, the real focus here again is on if the firm says it's doing something, then it should be following through. So there was in 2002 in March, there was an analysis survey of the 75 of the world's largest asset managers. 75, all of them were signatories to that principles of responsible investing that I mentioned earlier, that industry voluntary standards organization. But only 51% of those managers who say they are adhering, had evidence of integrating responsible investing across their assets and their strategies. So that again, it would potentially be a sign of greenwashing, that we're just saying, yep, we're adhering to this, but not actually following through. So really, it's clear now, based on that and other kind of the marketing review I mentioned, the regulators are expecting, policies and procedures. And so governance is obviously a focus here. What is the governance structure around sustainability, risks and opportunities? How are those integrated into the strategies? What metrics and targets are you using? Is there a particular, quantitative measure that is going to be used to govern and measure the success of the ESG related investments? Risk management, how do firms manage all these sustainability risk? So again, all focused on preventing greenwashing and all focused on making sure that investors have all the information they need to make an investment. So I'll end on this point, and this is, I think, where a lot of the controversy, or one of the areas of controversy for ESG investing, goes back to a fundamental duty that money managers have to their clients. And fundamentally, at the end of the day, there is an obligation in most instances for these firms to act in the best interest of their client, the investor. And there's also an obligation for them to deal fairly honestly and in good faith with their clients. So the challenge is that that's sort of always been viewed historically really as maximizing the returns, the investment returns, the financial returns for the client. So how do you then balance that with potential strategy that's more ESG focused, where there's other considerations at play, potential engagement by proxy to change like the culture at a tobacco company or a company that produces, military, arms or what have you. So how do you then justify that by saying, well, that may not actually be in the financial best interest of the client and the investor? So that's kind of where the professional balance comes in and the judgment. And others, people will argue that, well, implementing these strategies actually is maximizing the returns for different reasons. For instance, well, if you go to a company and you encourage them to adopt climate change mitigation measures, well, then maybe in the long run, you are help mitigating climate change, so that company can continue to function in the environment it currently does. So there are different arguments on both sides, but this is kind of where professional judgment for the asset managers come into play. And with that, I will hand it over to Miles.
Thanks, Michael. Hi, everyone. And Michael, you're going to be the AV guy, as we used to say in high school. Is that right?
Yep, I got it.
I'm kidding. Hi, everyone. I'm not a securities lawyer. I'm a commercial lawyer, what used to be called an oil and gas lawyer here in Calgary, although I'm now an energy lawyer, although I continue to do work for oil and gas clients all the time. And so what our presentation is going to be is I'm going to start and talk and provide some context and an introduction to the oil and gas business generally, so everybody has the background of the types of issuers or the types of clients, the types of participants in the economy we're talking about. And we'll talk a little bit about their ESG, their internal ESG requirements, and how those companies view ESG compliance and ESG disclosure, et cetera. And then Sinem will talk about the rating organizations that companies use to, or that the industries use to rate companies. And she'll also talk about disclosure, that the disclosure requirements that these issuers have. And then I'll do a quick conclusion. So that's where we are. That's the kind of thing we're going to be talking about. Also, feel free if you have questions to put them in the chat or put up your hand, and we're happy to accept them at the end or happy to do it now. So as we proceed. Okay, so Michael, I'm a Gen X person. Here I am. So that's my Gen X content from Dragnet. Just the facts, ma'am, just the facts. So this is what we're going to do is the first 4 or 5 slides are going to be entirely factual. They're drawn from, so if you go to the next slide, Michael, these are all drawn from, you will see a link at the bottom of the slide from NRCan, Natural Resources Canada. They produce every year something called a fact book, and it outlines in a very user-friendly way all the facts about all facets of the energy business writ large. So we are focusing on oil and gas today, but they also talk about hydro and biomass and renewables, i.e. solar and wind and consumption, and so it is the full gamut. If anyone is interested in the energy business broadly, I highly suggest you look at it because it really provides a lot of information about Canada's energy business and Canada's energy mix. So on this slide, we're going to talk about the oil and gas business generally. You will see that the oil and gas business, and by the oil and gas business, typically we would mean the upstream oil and gas business. So what I'm suggesting when I mean upstream is everything but to the inlet of a pipeline. So it does not include Enbridge or TC Energy, but it would include, or for instance, companies like AltaGas or Keyera. Upstream means in companies that are producing oil or gas or liquids from either wells or oil sands. So that's what we're talking about here, typically. So you will see the contribution that the oil and gas business directly makes to Canada's economy. It's represents nearly 6% of GDP. In terms of CapEx, $38 billion in CapEx. It represents 26% of Canada's GHG emissions. We will dig into that more. We understand what that means on slides coming. In terms of total exports, it represents nearly 1/5 of all Canada's exports. And Canada is the 4th largest producer of oil, so that would include oil and oil sands, and the 5th largest producer of gas in the world. So you will see, so obviously the oil and gas business represents a material part of Canada's economy, both domestically and for export. Okay, Michael. This is a slide that shows employees. So direct employees, there's near, between, and this varies, but between 175 and 200,000 direct jobs in the oil and gas business, plus 415,000, they say, indirect. That would include hotels in small towns for where oil and gas operations are undergoing those sorts of things. The oil and gas business and industry is one of Canada's largest employers of Indigenous people. So nearly 11,000 Indigenous people are employed in the oil and gas sector. Okay, let's go next slide, Michael. Okay, so let's talk about the oil sands. The oil sands exist in northern and north central Alberta. What oil sands are it is sand and oil mixed together, and they exist in muskeg. And so it's like you would expect to see, swampy sort of, it's sort of swampy land, etc. And from that, we'll come to how it's extracted on the next slide. But what you get out of oil sands is bitumen, which is like a sand. And then it can be transported to upgraders for processing to make it lighter, which is called synthetic crude oil. It would be, but nearly half of the raw bitumen produced in Canada or in Alberta was sent for upgrading here. The balance would be exported to the United States by a pipeline for upgrading in the United States, and that would be on the US Gulf Coast in Houston. There's the companies. You will see that it was Husky, now Cenovus, Syncrude, Suncor, and Canadian Natural are Canadian companies. Shell and Nex and CNOOC are not. Nex and CNOOC is the China National Offshore Oil Company, and that is a Chinese state-owned entity. Upgrading capacity is 1.33 million barrels per day. And bitumen upgrading is a major source of GHG emissions. In the oil sands, it represents approximately half of the GHG emissions comes from the upgraders. Moving on. So next slide, Michael. So this is the second way. The first way is mining. So they simply mine it. The second way that they obtain oil sands is what they would call in situ or SAGD, steam assisted gravity drainage. So you will see on this slide, you inject the steam into the formation, into the ground. It basically acts as a lubricant to extract the oil sands from the ground. So it makes it so they can be pumped out of the ground. These wells are not very deep, but they pump a bunch of steam into them. Here's what the additional issue of GHG emissions. I have a little opinion about this, which comes from the creation of the steam. So companies, by virtue of the fact that they have to create the steam to get the oil out or to get the oil sands out, have to they burn natural gas to create the steam. And the natural gas requirements in the oil sands are very significant. And so that represents the other approximately half of the GHG emissions from the oil sands is, from the creation of the steam. Okay, moving on. So here are other environmental considerations is water use. So the mining method of oil sands production can use a lot of water. You will see that it approximately uses 2 barrels of water for each barrel of bitumen it produces. Now, that water comes out of the Athabasca River. But 78% of that water is now recycled. So they use recycled water to obtain it. Similarly with the steam, there is some loss, but generally they recycle as much water as they can. It is a constant source of the water licenses that the oil sands company have are extremely strictly regulated, and they're highly incentivized to use recycled water. Okay, so moving on to the next slide. So GHG emissions. 11% of Canada's total, I think it was at 26 earlier, but 11% of Canada's total GHG emissions and 0.15 of global emissions. So you will see so 0.15% of global emissions represents a relatively small percentage, and Canada is a relatively small contributor to global emissions. So recognizing that the oil sands is a major contributor to Canada's emissions, and Canadians are on a per capita basis produce a lot of greenhouse gas emissions, possibly the most globally on a per capita basis. In part, that's because we have a relatively small population and we produce oil sands. So per capita isn't necessarily indicative of very much because our population is small. Now, you will see also that in the last 20 years, the emissions intensity of oil sands operations has dropped by about a third. But, as one of the next slides will show, but production has increased. So it may show that GHGs have increased, but they have not increased as much as they might have had there not been technological advances to reduce GHG emissions. Okay, next slide, please. So here's which you can see from oil and gas production have gone up 25%, largely from increased production and largely because of in situ extraction, which we talked about, which is the steam. But during this period, oil sands production emissions more than tripled, and conventional natural gas, oil and gas, so that's like a regular well, decreased by 14%. But on a per barrel basis, oil sands emissions have decreased by a third. So you produce more, you create more GHGs. The oil sands producers are doing their best to reduce emissions, but there's no way to necessarily to avoid them entirely. Okay, next slide, please. Okay, and so Sinem has, I'm going to pass it off to her, and then we have some comments just generally at the end. So what I've done is just set out a description of what Canada, in terms of its environmental footprint of the oil and gas business, and in particular with respect to oil sands. But at the end, we're going to talk about 2 or 3 other things: S and G, social and governance, and then we'll conclude. So, Sinem, over to you.
Okay, thank you, Miles. Hi, everyone. So I just want to talk a little bit about the storytelling aspect of ESG. As Michael talked about in his slides, there is requirements for companies under Canadian law to tell their ESG story, what their sustainability metrics are like. However, that's not really the main push when it comes to ESG storytelling, at least currently. You'll see online there's a lot of conversation about how government could be involved later, but right now it's mostly for public companies. So, for example, federally incorporated public companies do require to have some diversity disclosure, or if you're listed on the TSX, you will have some requirements that come from the TSX when it comes to diversity or governance disclosure. However, these are not really hard and fast rules for a lot of companies, especially the private companies. So the push when it comes to ESG reporting really comes from frameworks and different rating agencies. I've included a comparison of 5 of the major rating agencies and frameworks that we have out there. However, there are a dizzying variety of frameworks out there. The last time I checked, there were actually more than 600 different metrics that companies look at when it comes to ESG reporting, which could obviously mean that there is a lot of competing information out there. It's really hard to understand what ESG disclosure looks like for one company versus another. And at the end of my part of the presentation, I'll give you 3 different examples from larger oil and gas companies, so you can kind of see what different disclosure looks like for different companies. This, I think, is a good way of coming in. This chart that we have is a good way of understanding what's out there. So you have, as I said, different frameworks that talk about different things. When it comes down to which framework a company will use, the question is usually which framework will tell their stories the best. For example, if you are using CDP, you will likely be more focused on the E and the G of ESG, not a lot of the S factors of it. If you are focusing on, let's say, using SASB, which is Sustainability Accounting Standards, that is more geared towards investors, particularly US investors, because it will actually help you take your sustainability framework, sustainability information, and kind of walk you through how to use it for SEC disclosure. But it also works great in Canadian standards, because a lot of the requirements when it comes to SEC disclosure will be similar to what we have in the North. Next slide, please, Michael. Okay, so we've done when we were doing the research, we found this review that was done by Financial Post back in 2019, and what Canadian Investors Relations Institute actually found back in December 2019 were most of the Canadian companies that are publicly disclosing ESG frameworks were using carbon disclosure projects. That's at 72%, coming very closely. It was the Global Reporting Initiative. And these are more general and prescriptive frameworks that we use when it comes to the ESG disclosure. When you go back down to, and only 46% was using SASB. We at BLG have actually done kind of our own research when it comes to only the oil and gas sector to see what oil and gas clients were using. GRI was really up there again, talking about, it was 88%. But one thing that was different from the review of the Canadian Investors Relations Institute and what the research that we had done was more clients were using the Sustainability Accounting Standards Board and the Task Climate related financial disclosure. We don't really know what the correlation or what the causation behind this is, but some of the things could be SASB is, as I said, more directed towards investors. So a lot of the oil and gas companies will want to tell their stories in a way that works well with investor-related storytelling, but also be able to get their ESG story out. When it comes down to your clients, yourself, when you're thinking about doing ESG storytelling, I think the most important thing is to start by asking some very basic questions. Some of this could be, who are we trying to target this story towards? Is it going to be the investors? Is it going to be our shareholders? Is it going to be the regulators? On the other hand, you should also ask what kind of resources we have. Some of these frameworks have, out of the 600 metrics that I was talking about earlier, maybe 400 of them that you would have to look at. So a larger oil and gas client might be able to have a dedicated team that works year around on their ESG frameworks and reporting, but someone who's smaller might not have the same resources to actually spare for ESG storytelling. Next slide, please. So ESG reporting when it comes down to the Canadian energy sector. We, as the Canadian energy sector, are actually very advanced, especially when it comes to the top producers. The top producers that were on a study that was done by the Canadian West Foundation found that 100% of top producers were actually had some sort of ESG metric or framework that was published on their websites. Some of these companies will go the full distance and will have yearly reporting. So if you go into their websites, you can download their PDFs that are usually hundreds of pages long that talks about their ESG initiatives, that talks about all the statistics that Miles was giving in the aggregate earlier in the presentation. And you can really get a story of what they're doing. The problem comes in, obviously, as I was talking about, with the smaller oil and gas companies. So in the same research, it was found that only 20% of the smaller oil and gas companies had some sort of ESG reporting in place. This, again, comes in mostly because of resources. As a smaller oil and gas player, it might not be available to you to be able to put out this 100-page report on a yearly basis. That doesn't mean that these companies are not doing what they're supposed to, quote unquote. It's just that they don't have the same resources to put the story, the report out there as some of these larger producers. In Canada, we have incredibly robust environmental laws, incredibly robust governance disclosure requirements. So when it comes down to the bottom line, the story not being out there might not actually mean that they're not doing what they're not supposed to. Next slide, please. One thing that's really near and dear to my heart is Indigenous concerns when it comes to ESG. So I wanted to talk a little bit about the I in ESG. There is a push towards changing the name of ESG to ESGI to include Indigenous in ESG reporting. Right now, currently, I is covered under S, but a lot of the frameworks that I talked about either very briefly mention it or they don't touch Indigenous concerns at all. And this is actually one thing that the Canadian oil and gas industry is ahead of the game. We out here in the West have incredible relations with our Indigenous population because a lot of the projects happen in treaty lands. So a lot of oil and gas companies will bring in Indigenous groups as consulting them or having partnerships with them when it comes down to running these projects, and their concerns and their voices are heard more so than I would say many of the other industries that are out there. So it is something that is being definitely pushed in Alberta, especially in the oil and gas industry. But we do still have a lot of way to go. And I think it's good that our oil and gas industry is actually pushing this. Next slide, please. As I said before, we are, our ratings are in among top 20% of oil producers in the world. We are up there with Norway, UK, we're doing better than the US and better than a lot of the Middle Eastern oil and gas producers. So why do we get a bad rap? It is, I think, comes back down to the storytelling aspect of ESG. When you look at the oil and gas industry, it's not usually the best storytellers. They don't advocate themselves in terms of what they're doing and what's out there. We rate very highly on the social and governance side of things, but it seems that a lot of the media and investor focus comes in from the environmental sides. And again, as Miles said, part of this is unavoidable. It is just the nature of the industry. So we do need to focus on what comes, what we're doing better and how we're improving the industry. And the more we can get these ESG stories out there, the more the public will be actually aware of the oil and gas industry in Canada. Next slide, please. Okay, as I mentioned before, I just wanted to quickly touch on the different reports that are out there. So these will be very familiar with every companies to everyone on this presentation. So Suncor's 2022 report is actually out, and you can see that they've split it into environmental, social, and governance, and they're going to talk about different metrics when it comes to their their ESG reporting. What they focus on is their GHG, water, land. On the social side of it, it's the workforce, the safety, and you can go in. We've included the link to these reports if you want to just look through, see what's being reported. You can get an idea of what the larger oil and gas companies will be focusing on in their ESG reporting. Next slide, please. On the other hand, you have Enbridge, who are taking more of a visual approach to it. They're looking at, again, GHG, but on their end, it's Indigenous and diversity that's being also put out there, and board diversity when it comes to governance. And again, this goes back to my earlier point of there's 600 different metrics. So companies will take different things and will be looking at different frameworks when it comes to telling their own story. Next slide, please. And this is our last kind of ESG sustainability report that's out there. Parkland, when it comes to Parkland, they are focusing on the people side of things, and they've also included some diversity and inclusion, but different from what the other two sustainability reports were showing. There is a focus on employee training and their partnerships. So you can see in their high level view, Parkland didn't include Indigenous stuff, but if you go into their report, you'll find out that there will be more disclosure when it comes down to the Indigenous projects and so on and so forth. These reports, as I said, are 100 pages. We just wanted to give you a brief snapshot of their high-level summaries. If you want to go in, I would highly recommend taking a look to see what is being reported on and how these companies are using the frameworks and the sustainability reports to try to better tell their own stories. Next slide, please.
Okay, and so I'm yeah, right, and so and we've just got a couple of things to talk about here. In conclusion, the first thing is to understand that Canada has an energy mix, you know, which consists in Western Canada, for example, we get a fair amount of our electricity from non-sustainable sources. So in Ontario, it's virtually all from hydro. Same in Quebec and Alberta, we get a lot of our electricity from coal and increasingly from natural gas, although coal in Alberta is being mothballed by 2030. So they'll be closing all the coal-fired generation by 2030 and converting it to natural gas, but it's largely natural gas. So, but I mean, other things which we haven't talked about very much is sources of energy such as nuclear power. So for instance, in Ontario, nuclear power is an important part of the energy mix. In Western Canada, it just hasn't been. So for example, if we really wanted to reduce our GHG emissions in the oil sands, a nuclear power facility in the oil sands to produce, to create steam for the in situ projects would be would be a major source of reduction of GHGs. But that takes a lot of will and a lot of money to do that. But I mean, it's an obvious answer. There's no getting away from the fact that the oil and gas value chain, or the oil and gas chain from the underground reservoir to your burner tip on your gas stove or your exhaust pipe for your car, produces carbon dioxide and other GHGs. I mean, there's no getting away from that. So we're all, if you drive a gas stove, or you have a car, or you live in Western Canada and turn on the lights, or you heat your home, chances are you're contributing to GHG usage. So in producing these products, though, oil and gas companies have very high environmental standards, but there's no getting away from the fact that they produce GHGs. Accordingly, they end up having the highest standards of S and G, because you look at Sinnem's metrics, you're starting behind the line, because on the environmental side, because there's no getting away from the fact that you contribute GHGs to the environment, you have to be very high on the S and the G in order to maintain a rating. I think it's very difficult for us as Canadians to transition to a GHG free, or a significantly reduced GHG free quickly, but it's certainly something that everyone in Canada wants to do. Obviously, petroleum-based energy is efficient and transportable. For example, when the Mohawks blocked the highway a few years ago, one of the effects is the Quebec farmers couldn't get propane. Well, propane is a petroleum-based fuel, and so there was a big problem. Why? It's transportable and it burns quickly, and it's very efficient. So we have to, if we're going to transition, we need to understand that this is what it's going to cost for us to do. In the end, what seems most realistic is an energy mix, which, but I suggest we should flip the narrative on its head and say it should be prize preservation of the petroleum-based energy for when we really need it, because it's extremely valuable. And we don't want to be doing is burning it up, effectively buying the groceries but losing the house. So we burn it up when we have all this other ways of getting energy. We should be saving it for when we really need it. So hopefully in the next, few generations, we transition so that the lion's share of energy consumption is renewable. Nuclear, hydro, wind, solar, and nuclear doesn't really count, but it's much less impactful on the environment. But I think everybody has to be clear-eyed about the fact that it'll take many years and trillions of dollars to get there, but I think we need to do it as a society. That's not really that political, but it's a little bit, but I think it's a little bit, but it's not that political. Okay, final slide. And this is actually from yesterday. So this was me out in Calgary yesterday, and that's a picture of a pickup truck at the hotel next to our office. And you will see, so Vermilion Energy, a mid-sized producer, HSE, everywhere, every day, everyone. HSE is health, safety, and environment. And so they get, that is all encompassed in the E of ESG. This is a typical messaging from an upstream oil and gas company, making sure that everyone knows that they take it seriously, but also that their employees are proud of their commitment to health, safety, and the environment. So that's it. Why the government still, and so we have a question in the chat which says, with all these details about oil and gas efforts and compliance, reducing greenhouse gas and commitment to net zero, why the government still finds it difficult to invest more in the sector, especially with the idea of banning oil sands oil. I think the answer to that question, well, it's a very complicated question. I mean, I think banning oil sands or trying to get away from banning oil sands oil seems unrealistic. But there are ways of making oil sands production less environmentally harmful. It's a very, very complicated question. I think in fact, it doesn't fit nicely into a soundbite, to be honest, and I think, or to be blunt. And so I think, further to what Michael and Sinem were talking about earlier, in part, it's about how the media describes it, and it is easy to, it'll be easy to it's easy to sort of create to vilify energy companies, and to, honestly, 30 years ago it was easy to do so. These days it's much more difficult to do so on this front. I mean, there's no getting away from the fact that the energy companies produce GHGs and can have an impact on the environment, but it is a heck of a lot better than it was when I started practicing 30 years ago. Second question, how do you predict the role of internal auditors in ESG reporting? I, with my undergraduate degree in history, I don't feel capable of answering this question. Michael, I'm going to pass it off to you or to Sinem.
Yeah, and maybe I'll pass it on to Sinem, because I don't know the answer.
We're seeing it in the U.S. It's going to come. I mean, it's going to come. Like, if you look at the annual reports that companies get from the auditors, ESG continues to play a major role. I expect it's going to form part within 10 years. There'll be a required statements and required stuff in financial statements that'll be, require audited disclosure of certainly of environmental stuff. I think that's just the way it's going to happen. That's the way of the future.
Yeah, I agree. I think that's kind of the trend. It's starting to, you see it in disclosures, you see it in regulatory required filings, you see it in that. So I think moving over then to the audit would not surprise me. I don't know, Sinem, if you had anything to add on that.
I'm seeing another message coming in saying audit firms are not designated.
Or she's saying now designating a person to be responsible. That's right. I mean, I think that's right.
That's
the question
correct.
Is, yeah.
Sorry, I was just going to say it's we're seeing a lot of financial push when it comes to ESG. So the accounting firms and internal auditors are definitely pushing it. But we also have a new phenomenon coming up, the ESG consultant. I'm seeing more of this coming from the States, but the ESG consultant does really help with the audit, and even before the audit, the actual preparation of the policies and the enforcement metrics when it comes to ESG. So that might be something that pushes this.
And the other thing we might see is similar to what you would see in the mining or oil and gas business with respect to reserves. So you have reserves disclosure, which is required as part of the public disclosure, right? 51-101 or 60, Sinem, you'll remember what it is under the mining business. 61-101, am I right about that? I can't remember. Anyway, there's annual reserves disclosure, which is required as part of your public disclosure. And so query whether the securities regulators are going to set up a particular reporting thing similar to 51-101. I mean, I don't know. It's certainly possible. People want to know this stuff, but there's a push for standards. The difficulty, as Sinem has pointed out in her presentation, is that there are 5 or 8 or a zillion rating agencies. And so if you're an investor, how are you going to know? You can't. And so in the end, the market is sort of dealing with it because there are, people are gravitating to 3 or 4. But you have to think that in the next, 10 years that there will be a standard and that people will hew to it. I mean, I think some of the stuff we're seeing out of the SEC suggests that that's where they're headed. But anyway, it's in a time of flux.
Okay, well, great.
Do I see Canada pushback on ESG following recent American pushback? I'd say no. I'd say we're boots in on ESG.
I agree. I don't see yet, in Canada, a retreat, in my space from what asset managers are doing. So I don't think there's going to be any retreat.
Well, and frankly, issuers are proud of their compliance, so they want to tell the story. So I think I mean, if you were to ask a general counsel of any resource-based company, mining, oil and gas, even a renewables company, what their top 3 things that are of concern, ESG issues are always in the top 3. And 10 years ago, that would not have been the case, but these days, absolutely. So we're gonna be, full bore forward, I think. Any other questions?
Thank you so much. Yep.
I'm just seeing if we have any more other questions. Let me say on behalf of BLG, thanks very much for the opportunity, you guys. Michael.
No, you're welcome. Thank you, Miles Cinema, and thank you, Claire. Have a great day, everyone.
I just want to thank you all for presenting. That was fantastic.